on the slideshow. All right, so when we are talking about, we just went through analysis of the balance sheet. Hang on one second, let me change these display settings. All right. Okay, so we just went through analysis of the balance sheet and how the balance sheet is presented. Now let's again, all this should be on some level, a little bit more detail into it, but now let's look at the income statement. All right, so here's your competencies, those are your learning objectives, okay? I won't read them to you. So let's take a look and let's do a little bit of review on what we're looking at when we see the income statement, all right? Number one, we've got two types of, well, probably really more like three different types of income statements. Yes, ma'am?
For the last one, we only had internal users?
No. In last class, we only focused on external. Okay?
Okay.
We really focused on external, okay? All right, but here's the deal. We talked a little bit about internal, but we focused on external. So in here, we basically have three different formats of the income statement. Now, don't miss the fact that we're going to look at them and compare them all together here in just a minute. But they present the same information in a slightly different way, and we use them differently just depending on what our focus is, okay? So if we're looking at internal users, okay, we're talking about executives, board of directors, division managers, general managers, area supervisors, right? All internal folks. Now, when we're talking about internal, the more data that we have, the more detailed breakout of the data that we have, the more useful it is, because then we can start analyzing things like when we're at the executive and board of director levels, we can analyze the entire corporation or the entire company in one income statement. When we are looking at division managers generally, remember, they only can control the division that they're in. So we might give them a division income statement, okay? So how did your division do as far as revenues coming in? How did your division do on cost, right? So they would get a more detailed division income statement. General managers, now we're talking about a specific location within that division. So maybe the division manager is like the U.S. division manager, or maybe even a North America that would include both U.S. and Canada kind of thing. When we get down here to general managers, now we're talking about a very specific location within the U.S. or Canada. So maybe we're talking about the Charlotte location, okay? So then this general manager would only get the income statement from their specific location. How did revenues go within that location? How did expenses go within that location? Then we've got area supervisors. Now we're going to break it down even further. So when we talk about area supervisors, again, they can only control their area. So maybe now we're looking at the kitchen manager. So they're going to get the breakout, and really with them being in the kitchen, not really going to get anything on the revenue side because that's not their deal. That they're not about sales, they're about cost containment. So they will probably only get an income statement that only included cost, versus maybe the area supervisor that's over the entire restaurant, okay? Now they're going to get revenues and cost, okay? For not only back of the house, but front of the house, right? Okay? So when we're talking about income statements, who is getting that income statement is going to determine what is actually on that income statement. Because think about what would happen here. If if you are the kitchen manager for the Charlotte location and somebody sends you an income statement that includes all the data from the entire company, not helpful, right? Because you can't see what you were actually able to affect. Okay? So they're only going to get the information that they can affect in their area. Okay? That's part of the reason why the income statements from the hotel and hospitality industry, those fixed costs get pushed down to the bottom of that income statement. We looked at that last class. They get pushed to the bottom because those are decisions that have been made at the corporate level that we, as these local managers and division managers, we can't control that. That decision was out of our hands, okay? All right, then when we've got external users, now we're looking at a whole lot less detail. We're only trying to provide them with the overall company information. They don't get any of the details from any of the divisions or anything else. One other big thing about an external user income statement is it has to comply with GAAP, okay? So when we're talking about internal statements, we can put together internal statements any way that we want to. There are no rules or regulations that we have to comply with, okay? So when we're looking at these, there's absolutely no rules. It's just a matter of what is the internal functioning of the company. What are they doing and how are they doing it? How are they breaking it out and who gets what? Okay? No rules up here. Okay? Rules down here. GAAP has to be complied with. International financial reporting standards, if we're talking about international statements. So then we're talking about external users. Now we're talking about stockholders and investors. That's equity section. Creditors, that's the liability section of our balance sheet. And then we've got analysts. So now we're talking about the analysts for maybe the banks or something like that, or a big investment house that is focusing on our industry maybe. Because these analysts, they specialize generally in a certain industry. So one analyst may focus on hospitality industry, one analyst might focus on banking. So then that way, when they take your financial statements from the hospitality industry, they analyze your statements, and then they can compare them to some other hospitality organization that's in the same industry and in the same sort of size, right? To get a good comparison between the two, okay? So external, a lot less detail. Internal, a whole lot of detail, as much as we need, all right? Remember, income statement, we're looking at revenues and expenses, and it is presented for a specific time period. So remember, the date at the top of that income statement will read something like 4-month end and a date, 4-quarter end and a date, 4 6 months ended and a date, 4-year end and a date, okay? So that date at the top of the income statement gives you a lot of information there when it's telling you what time period we're looking at. Because you certainly couldn't take a monthly income statement and effectively compare it to last year's annual income statement, right? If we get January of 2017, we need to compare January of 2017 to January of 2016 to get an effective comparison. Because remember, this is all about comparing last year, this year, projecting next year. Okay. All right, other things to remember. Accrual basis accounting means realization principle. We record revenues when they are earned. Okay. Matching principles, any revenues that we record up here, we have to record all the expenses that are associated with earning those revenues. Okay? Now, remember, earned does not equal collected. That's what the accounts receivable account is for, so we've provided the service, we've earned it, but we haven't collected it yet. And unearned revenue, we've collected it first, we're gonna earn it later, okay? So remember, not collected, it's all about earned, okay? And again, specific time period. All right, so, I think who'd you have for accounting? Yeah, you did have, okay, that's right, because you were, all right, I'm trying to remember. You were in my class too for accounting 1, right? Okay, all right, just trying to make sure. Yeah, all right, so we looked at this last term, okay? I pulled this straight out of the book. It is the exact same income statement, internal, that we looked at last term. Now, remember, when we're looking at this financial statement, internal, again, realize that whole area, general manager, internal type of financial statement, the manager for the rooms department is only going to get the breakout from this one line item right here, okay? Food and beverage manager is going to only get the information from this one line item right here. Then the food, maybe there's another level down that maybe the food manager gets one of some portion of this, and then the beverage manager gets another one that's some portion of that line, okay? Then you've got telecommunications manager, other operated departments, okay? So each individual operated department, that manager is going to get that specific piece, right? Okay, and then the rentals and the other income generally going to fall under the general manager of the location. All right. Then we come down here to our undistributed expenses. Okay, so again, remember, undistributed expenses, there are no revenues that are involved here. Okay, it's only cost, and it's payroll and others. So we have people in these support departments. So our administrative in general, that is, you know, our general manager, that's our accounting department, that's maybe our sales department, well, no, not sales, because sales is going to be under marketing, okay, so there's our marketing department, sales there as well. There's our property operations and maintenance folks. Here is, again, utilities. Now we're talking about just utilities, so no people, but we do have our utilities expense, okay? So again, this fixed charges section, again, the reason why this is broken out down here is because these decisions here are made at the corporate level, and these folks up here can't control any of that. None of the managers of those departments can control this section. Only the corporate managers can control that, okay? So look at what we're moving into. So here's our internal long form. Here's our internal short form. So notice what happens here. We lose an awful lot of detail, but look at the numbers here. Those numbers should look at least a little bit familiar because those numbers are right here, right? So we lose this portion back here. So maybe in this particular case, we're looking at what I imagine that the first page of the corporate financial statements internal package is going to look like to the corporate managers, okay? Then the second statement is probably going to look something like that, so they can see how the folks below them are functioning, okay? Again, same thing here. Under our undistributed expenses, we lose a lot of detail, but again, those numbers should look fairly familiar because here they are right here. Okay. And then the remainder of it is the same. Okay? We list out our fixed expenses. There's our little gain or loss on property. There's our income taxes. Okay? But again, all internal. The less detail we have indicates the higher the management analysis of it, okay? The more detail we have indicates the lower level management layers that are looking at it. All right. Then we've got our external format. Now again, same exact information, but we're changing around how we present it. So again, these numbers right here should look a little bit familiar to you, because if we go back, it's this column right here. Okay. So if this, in this particular case, when we get to external, we're basically doing revenues minus expenses. Okay. All right. So then here on all of our costs and expenses, every bit of this is, if we go specifically look at rooms, that 205, 239 is the total of the payroll and other expenses here, okay? When we look at the food and beverage expense total, it's the cost of sales, payroll, and other. When we look at telecommunications, again, it's cost of sales, payroll, and other, okay? As they're grouped together. Same thing with the undistributed expenses, okay? So if you want to take a look at this in detail, all of these top 4 expense items there are those grouped by department. Then there's our same administrative and general marketing, property operations and maintenance and energy costs. That's going to be the totals from each one of those departments. Then again, we're going to do bring those numbers over for the remaining, okay? So it's all the exact same information, because notice what happens here. Net income, $60,544. Net income, $60,544. Net income, $60,544. All the same information, just simply grouped and broken out in a different way. Okay. All right. Also notice that the dates appear at the top. Okay. 4 year ended, 4 year ended, 4 year ended. Okay. So we know when it says 4 year ended that it's the previous 12 months. Okay. Again, this should be reviewed. Okay. Just a slightly different, a little more detail to it. Okay. Then, once we've got all of our financial statements put together, again, we're going to go through and we're going to analyze them. Now, notice the version that we're using here. We're using the external analysis. Okay. So, here's our external numbers. Okay. We're going to do a common size analysis. Remember, common means common divisor. Okay. So in this particular case, we're going to take each one of the revenue numbers and we're going to divide by, the total departmental revenue. Okay. So our common divisor in this particular application is the 1.597 for the total revenue. So it looks a little bit odd, okay, but go with it, because this total revenue number, everything above it should total down to 100%. And again, you do need to round to make it actually foot to 100.0. Okay, you don't want it to be 98.9 or 99.8 or something like that. Okay? So here's our common divisor. Okay. Now, when we move down here to the expenses, now we're still taking each one of those numbers and we're dividing into total revenues. Okay. So if we want to break out our total revenues, going back to the top, okay, we can see that a great majority, well, a somewhat majority, a little more than majority, of the revenues that are coming in from rooms. That's our biggest thing. Yes, ma'am.
So you don't take, like, you don't start from the bottom. You take from the total or?
From the total revenues, that's
Okay.
going to be, because you saw when I did it, it's like, you know, we want to do common divisor and we want to go all the way to the bottom. We don't divide by net income.
Okay.
Right? We divide by total revenue.
But how come you don't do the cost expenses by their total?
Good question. We're getting ready to get there. All right, so hang loose. All right? So does everybody see though that the common divisor is total revenues, all departments, okay? So if we want to look and now do some analysis, we can see 56.3% of total revenues comes from rooms. 32.8 comes from food and beverage. Those are the two biggies. So it would be the kind of thing where when we are projecting for next year, okay, we may look at this year's income statement and say, you know what, we'd really like for the sales distribution to be a little bit different here. Maybe we want to bring food and beverage up to 35%, right? So that's our goal. Maybe we're happy with where rooms are, but we've got to get more people using our restaurants and facilities and that sort of thing. So then we would up the allocation maybe next year our goal is 35%. So then we can see, based on one, can we see that total revenues are increasing? And then as we see total revenues increasing, we can see what the percentage of the breakout is. Because then that way that's going to tell us a lot of information about if revenues are increasing, 2 thumbs up, that's good. But then the question becomes what happened, okay? Did the breakout of it, did revenues from rooms drop? And the revenues based on our marketing campaign for the restaurants, did that increase our percentage of revenues for the food and beverage department? So maybe that marketing campaign went well and we actually had more revenues coming in from the food and beverage department, but something's happening in our rooms department such that maybe rooms have stagnated or maybe have even fallen off. Kind of get the idea here? So we've got to figure out what percentage of the total revenues are from which department. Okay? The other 3 items here, the percentages may fluctuate just a little bit, but I would imagine that those 3 numbers in total won't change a whole lot. Because whatever our rental is, I mean, if those are long-term rentals, they should that amount in total, dollar amount should stay about the same, okay? Then, getting back to your question, Julia, the whole thing about we take each one of those expenses and divide that by total revenues. Now, think about what the breakout is here. Out of every dollar that we earn in revenues, we're spending 12.8 cents for rooms. We're spending 27.4 cents for food and beverage. We're spending 4.9 cents in telecommunications, right? We're spending 10.3 cents in administrative and general. You get the idea here? Mm-hmm. So now we can look at our goal of, well, we were really hoping for administrative and general to be below 10%. That's our goal on that area. So then we go back and we think, all right, what happened? Did we have, who knows, maybe we had to have some big corporate analysis for our location this year or something where everybody had to pitch in, there was a lot of overtime, and everybody had to get that done. So if we can explain it and it's something unique that popped that up to above 10%, then we're probably okay with that, because then next year our location is not going to get analyzed again and is not going to be gone through and audited essentially. So we're good to go, and this has been just a little bit of a fluke for this particular year, right? You get the idea? So this is where accounting gets really interesting, but the thing is you have to know what goes into those. So remember, Those are earned revenues, not collected revenues. These are incurred expenses, not paid expenses, right? So again, overall, look at what's happening here. So for every dollar in departmental revenues that we earned, we've spent 95.9 cents in every dollar that is absolute have-to kind of expenses. Then we had a little bit of a bump here in the gain on the sale of the property of 0.7, and then, and this income tax rate, by the way, is really way out of whack, 1% on income taxes. So when we look at this overall, for every dollar that we earned in revenues, we get to keep 3.8 cents. Okay? Razor thin margins. So when anything changes, even if it's a fraction of a percent, that can be big when you're dealing with income margins of 3.8%, right? That's the reason why, you know, if you're in the kitchen right now, that's the reason why the kitchen manager is just absolutely maniacal about waste, right? We don't want to waste anything. Right. All right, good place for a break here. So let's be back.